It's okay. Is it the Gallatin thing that you've read the thesis? $3:30. So I'm going to start. So I can after class. Okay, folks. Couple of things. You know what's coming first, right? How many of you have not picked a company to value yet? Oh, I'm not going to follow up. I will assume you will get there. Because next week is an odd week. We don't have class on Monday, but we do have class on Tuesday. It's the first Tuesday I've taught in 40 years at NYU. I don't like teaching Tuesdays, but this semester, because the way the semester started on a Tuesday, this is how they're making it up. There's a Tuesday class from 3:30 to 4:45 in this room. So come to class. So there's both Tuesday and Wednesday. So next week we have 2 sessions back to back. But you do have a long weekend. And the nice thing about President's Day weekend is it comes with no obligations. You don't have to call your mother. That's Mother's Day. You don't have to hang out with family. That's Thanksgiving Day. I'm not even sure what you're supposed to do on President's Day, which means you have a wide open weekend, a 3-day weekend. And here's what I'd like you to do. Pick a company. Find a risk-free rate. So somebody remind me again, Akshar, how do you come up with the risk-free rate? What do you have to first do?
You check what was the treasury bond.
First, pick a currency, right? Don't go checking stuff until you pick a currency. Once you pick a currency, then go looking for government bonds in that currency, and then check to make sure the government bond is default-free. If it's not, some cleaning up to do, right? Risk-free rate. What about equity risk premiums? What do I require to get an equity risk premium?
The region.
You need to know where the company operates. So go looking through the footnotes, and somewhere in there, you'll see a geographic breakdown. You might not like the way they've done it. I might not like the way they do it, but you got to live in the world you're in and do the equity risk premium based on what they break the world down into. So you got a risk-free rate, we got an equity risk premium. What's the third and final number I need to get a cost of equity? Beta. There's so much mythology about beta that I want to dispel today. Because especially if you've taken multiple finance classes, that mythology gets embedded in your head. But remember, why do we need a beta? To get a measure of relative risk. So let's step back and think. So today's start of the class test is going to be about the very idea of beta. What is this beta going to? It goes into cost of equity and cost of capital, and we're trying to do intrinsic valuation, right? But if you've taken a finance class, what do we use to estimate betas? Returns, which come from stock prices, which comes from the market. And already you can see one reason a lot of old-time value investors don't like betas. They say, look, our job in intrinsic value is not be driven by the market, but to make judgments. And if you take the beta and get it from markets, aren't you in fact using a market price-based estimate of risk when you should be using an intrinsic value measure of risk? So if you use betas around value investors, there are a lot of people who don't like betas for lots of different reasons. And if you happen to already have a point of view on betas, I want you to dig a little deeper. And right now, you might not be ready to make a choice, but think about it. What it is about betas you don't like. And I'll list some of the things. The first is maybe you don't think you should adjust discount rates for risk at all. You think this whole exercise in risk adjustment is just like navel gazing. Every company should have the same cost of equity. There are enough people out there who believe this, that they think there should be no risk adjustment. Every company gets a 10% cost of equity. The second is, you don't like to use a measure of risk based on past prices. You think there should be a risk measure, but you think it should be based on earnings or something more fundamental. The third might be, you're okay using prices, but remember the implicit assumption we make when we use prices to get a beta. We're assuming the marginal investor is diversified, and all you care about is the risk you cannot diversify with. Maybe that's the thing you have issue with. Maybe you should be looking at total risk. Or maybe you're okay with both prices and diversified investors, but you just don't like the fact that regression betas are all over the place. You pick a different index, you get a different number. I'm not going to make you pick for the moment because I'm going to let you kind of ponder. Because if you don't like betas, I'd like to know why, because I can fix it then. Right? There is a solution to almost every one of these problems. Right? We'll talk more about this, but in your finance class, remember you're asked to run a beta, and it was very simple, right? The returns on the stock against returns on the market index, the slope of the line is the beta. You came out of the class, said, this is easy. Then you get on a Bloomberg terminal, and you type in the word beta for your company. I hope you guys have got your capital IQ going. And at some point, the Bloomberg terms for the undergraduates, where are they? Are they in this? Yeah. Get on one. You need it for only about 10 minutes. Find your company, assuming you picked a company and you all said you did. So I'm going to take you at your word. Type in the word beta. You see a beta page for the company. Returns on the stock, returns on the market index. We're going to dig a little deeper into that Bloomberg beta. But what Bloomberg allows you to do actually is change the index, change the time period, change the returns from daily to weekly to monthly. And what you're going to see is as you make those choices, you're going to get different betas. And you can use only one. We'll talk about how that process plays out when analysts do this. But if you take a company like Petrobras, I can take the local listing in Brazil and run it against a Bovespa. That's a default index for Brazil. And I get a beta. The beta that I get is 1.66. But Petrobras has an ADR listed in the US. An ADR is just a company listed in the US trading in dollar terms. And when I look up the regression for Petrobras' ADR, it runs it against the S&P 5 and it comes up with a beta of 1.98. So you're valuing Petrobras. Which of these two numbers should you use? What do you think, Akash?
Like Petrobras, like what does Petrobras do exactly?
The oil company.
What company? I guess where is it getting the oil?
So that's an equity risk premium question. Do not ask that question because then you're mixing up what should be driving equity risk premiums with what drives beta. Beta is about business, right? It's an oil company. The fact that it's in Brazil shouldn't drive the beta because then you'll be double counting country risk. It's an unfair question because these are both crappy betas, right? Why are they crappy betas? Remember your statistics side. When you run a regression, you get a slope, right? And if this were a statistics class, what are you trained to put in brackets under that slope? The standard error, basically telling the world, look, guys, I'm not certain. It's a practice we conveniently forget right after we leave the statistics class and become consultants. And we tell companies, this is what will happen if we told them the standard error and what we know. They're never going to pay us. We're going to talk today about the problem with regression betas. When you take one period, you take one stock, you do it against the index. Because there's a heck of a lot of gaming that's going to go on here, right? Remember we talked about bias at the start of this class? Let's suppose, I asked you a question, what do you, let's suppose you want to find Petrobras to be cheap because you're trying to sell Petrobras to a client. Which beta are you going to latch on to? You want a higher beta? Because remember, you want to convince them it's cheap. So basically, you want the value to be higher than the price. You want a higher value. To get a higher value, you want to go with the lower beta, right? So if you want to make the value higher, you pick the lower beta. This game is just a game. You're going to pick the beta that best fits your story. And people say, what choice do I have? Today, I will give you a choice where instead of running a regression and trying to figure out what to do, we'll talk about a way you can get around the statistical problem. So let's get the process rolling. Let's go back to where we were in the lecture notes. And talk about betas. So I was taught betas the same way you were. Right? I was told to run a regression, take the slope of the line, and say that's a beta. It's a horrifically bad way to think about betas because it makes beta into a statistical number, right? Something you look up. In fact, I'm going to argue that there are three reasons you should never trust a regression beta. Almost every beta you see from Yahoo Finance, from Bloomberg, is a regression beta. First is what I talked about, standard error problem. You're going to see how big that can be, at least for some companies. Second, is your beta backward looking or forward looking? It has to be backward looking because your returns came from the last 5 years, the last 2 years. You can't do returns for the next two because you don't know what they'll be. It is backward looking. And if your company's business mix is changing, it might not be the right beta for the company that you're valuing today. And third, it also reflects the fact that when you estimate a beta, you're building in the leverage. We're going to talk about how debt affects betas into the beta. And if that debt mix changes, your beta should change as well. So I'm going to start this process off with a regression beta for a company called GoPro. Remember GoPro? Basically, they produce cameras for overactive oversharers. So you went on a 3-hour hike. You recorded every moment of the 3-hour hike as if the rest of the world cared. Then you put it on YouTube, come on a 3-hour hike with me. For a while, it was a very hot product. Very risky company, right? But take a look at the beta that I get. We'll come back and talk about it. There's the beta 1.4. You're saying, this is good, I have a beta, but before you use it, keep going down and you will see a standard error of the beta, 0.50. So help me out here. This is a statistics class. I tell you the beta, the raw beta is actually 1.60. The beta is 1.60, and I tell you the standard error is 0.5. If I ask you what the beta for GoPro is, and you were being honest, not giving me a number, you should give me a range, right? And what's the range going to be if it's standard error is 0.5?
Because it's like if you're doing two standard deviations, then you do like what, 8?
Let's pause right there. 2 standard deviation. 2 times 0.5 is +1 and -1. 1.6 plus 1. 1 so my beta could be anywhere from 0.6 to 2.6. Thank you for letting me know. This is very useful. And I'm being sarcastic, but that's what you get out of the regression. Regression betas are noisy. You're saying, what's the adjusted beta? I'll come back and talk about the adjusted beta in a moment. But once in a while, you might think you hit the jackpot and your beta will look incredibly good. You should get even more terrified of what you've just discovered. I've saved this beta page for 25 years. The beta page I got for Nokia. This is right after the first Bloomberg terminals arrived at NYU. Got on, typed in Nokia, and I get a regression that's almost perfect. Every point is on the line. The R squared is close to 100%. The standard error is close to 0. So why is my Nokia beta so much more precise, at least if you think of precision in terms of standard error, than my GoPro beta? Anybody want to try? Yeah.
Larger data set?
It's same number of years, 2 years. So basically, I don't have more weeks. It's exactly the same number of weeks. That's clear. So it could be that you're saying GoPro is more volatile. I'll wager if I took a mature US company like Coca-Cola, I would still get a much larger standard error for Coca-Cola than for Nokia. So even if I control for that, so you're right, part of this is different kinds of companies, but there is actually a bigger wild card in here that's making the standard error really low. With Coca-Cola, if I ask Bloomberg for a beta, it regresses against the S&P 500, right? Why? It's very parochial. It goes to the domestic index of where it so when I asked for Nokia, guess where it went? It went to the hex. My first reaction was, I don't even know this is an index. I thought it was a witch's curse until I ran the regression. You know what the hex stands for? The Helsinki Exchange. You're saying, what the heck is Bloomberg going to Helsinki for? Nokia is a Finnish company. Bloomberg is doing what it's trained to do. It's go to local index. I had no idea what was in the hex, and I took a look, and I wish I hadn't. Because in 2000, I think Nokia owned Finland. It was 80% of the hex, 80%. So what's this regression? A regression of Nokia against Nokia. And what are we finding? The two move together. Amazing. I never thought that would happen. This is almost a useless regression. Here's why. The largest single investor in Nokia in 2000 was not a Finnish investor. It was Barclays as part of their global index fund. And if you're Barclays looking at how much risk there is in Nokia, you're not measuring risk against a Finnish index, you're running it against a global index, an MSCI. And guess what happens when you shift from the hex to an index like what's going to happen to the standard error? It's going to go up. It's a feature, not a bug. You're always going to have noise in your beta. And if you don't, you should worry about what your index looks like. So your beta is not useful when it looks noisy. Your beta is not useful when it's too precise. You're saying, when is my regression beta ever going to be useful? And along the way, you probably say, what about that adjusted beta? Sounds like it's adjusted, right, for something. You know what the adjusted beta is? In the old days, Bloomberg actually used to give away the game. The adjusted beta for every company that Bloomberg estimates a beta for, like 40,000 companies, is the raw beta times 0.67 plus 0.33 times 1. The heck are they doing? Let's try this out. If your raw beta is 1.8, your adjusted beta will become 1.53. Raw beta is 1.5, will become 1.33. 0.6 will become 0.73. What's happening here? What are they doing to every regression beta?
Just washing.
Towards 1. What's so magical about 1? It's the average beta across all. They're trying to be helpful. The response is, please stop helping. Because all they're doing is taking every beta and moving towards 1. That's what's probably going to happen. But these weights must be magic weights, right, to work for 40,000 companies. And I wanted to know where they came from. So I called Bloomberg, not the mayor, but the company. For a while in New York, you didn't know who you were calling. Maybe I should have called the mayor. I called Bloomberg, and they put me in touch with the beta calculation guy at Bloomberg. There's actually a guy at Bloomberg whose entire life is maintaining this page. Imagine how exciting his life must be. Goes to cocktail parties. I'm the beta guy from Bloomberg. Dozens of people gather around for anecdotes. Not. This guy was desperate. I mean, I think they kept him locked up in a basement room and fed him through a hole in the wall. You know, he was so thankful that I'd called. He said, so glad you called. I have all day to answer your questions. I had about 5 minutes of time left. But I was afraid if I hung up the phone too soon, he might do something rash. So after a few minutes of what I thought was polite conversation, I hit him with the question, why 0.67 and 0.33? Where did that come from? 2 minutes of silence. I can hear papers being rustled, terminals being turned off and on. And he comes back on and says, I don't know. It was here when I got here. I said, what? I said, I was hired 2 years ago. It was already there. Don't blame me. I'm not trying to blame you. I want to figure out where those numbers came from. Nobody at Bloomberg had a clue. So I had to do my own digging. I found the original source. It was a paper written in 1971. Remember that year? Where a researcher had looked at 100 companies. Why only 100? In 1971, he hadn't collected data. That kind of kept a limit on sample size. And he tracked the betas of these 100 companies over the 10 years. And guess what he found? The betas tended to move towards 1. And the statistical estimates, called a Stein estimate, is roughly with this 2/3, 1/3 weighting. 1971. See, how the heck did you go from 1971 paper to a 2001? That Bloomberg still uses those weights. I'll give you the conduit that brought it there. The very first beta estimation service was called BARA. It's a Berkeley-based service. It's founded by a guy called Bar Rosenberg, who was a professor of finance at the University of California at Berkeley. He was a journal editor of the journal in which this paper was published. So and he started his beta estimation service. Guess where he went looking for ideas? Oh, there's a 1971 paper. I'll put 0.67 and 0.33. This is 1974 when he started this. And then it becomes embedded, and nobody ever asks, where did that come from? There's so much of what you're going to face. When you go out to work there, where you're going to see a number and say, where did that come from? You know what the answer is going to be? I don't know. It was here when I got here. When did you get here? 1965? You've never wanted to ask a question? I don't lift rocks and look under them. I would strongly recommend that you pick up rocks and look under them because there's nothing here. If you're going to use a beta, use a raw beta. What's the adjust beta? Just tells you which direction one is. If you're confused about that, then you have far bigger problems than this class can ever solve. You want to go, you're at 1.6 to get to 1. You know how you get there, right? Go 1.48, 1.36, 1.24, 1.121. I don't need somebody holding my hand saying, give me a number closer to 1 because I'm really confused. So don't get dazzled by the adjusted beta part. There's nothing adjusted about it. And there's one slice of history. Because you run a regression. If something weird happens during that period that makes the stock move in ways that have nothing to do with the market, you know what's going to happen to your beta? It's going to move towards 0. Because betas measure how you move the market. Remember the sad but true story of GameStop? This is the stock that got picked up out of nowhere, became a meme stock, got pushed up to 400. There's the stock, right? It started, you can see the zooming up. If I just focus on the graph and say, is this a risky stock? Your answer is going to be, of course, look at it, it went up from 20 to 400. I ran the beta page, and you might not even be able to see it there, but if you take a closer look at the beta that I get is actually negative. Why? It's because this stock started moving and it had nothing to do with the market. Betas measure how you move with the market. So if something weird happens during your time period, your beta is going to lose all connection to reality. There's no way, if I'm valuing GameStop, I'm using a negative beta. So don't be surprised to see a negative beta for a stock where something during the 5-year or 2-year period just made the stock move on its own. And we talked about the gaming, right? I tell people, look, you give me 30 minutes, tell me what beta you want for your company, and give me access to a Bloomberg terminal. I will deliver a printed page with the beta you want to see. I'll try different time periods, different indices. I can even do trade prices, bid and ask prices. And by the time I'm done, you want a beta 1.2? No problem, I'll deliver a beta. This is why if you see a banker put up a Bloomberg beta page, you know the question you should ask him is, or her, how many beta pages did you try before you got to this one? I mean, they make it look like a fact. Like, look, it's a Bloomberg beta. It depends on how many tries you got. There are lots of gaming going on. What I'm trying to do is dig a hole for regression betas and bury them. It's a terrible way to think about betas. They're noisy, they're backward looking, they can be subject to gaming. And of course, you can always stop and say, I don't like betas at all. And that's why I asked the starting question. What is it that you don't like about betas? If it's the fact that you don't like to use stock prices, I have a solution for you. I can look at your past earnings, look at your volatility in earnings, and make that your measure of risk. I'm willing to do that if that's the fight. You could even say, well, I'm worried about debt, how much debt a company has. That's my measure of risk. No problem. I can build my risk. I am not wedded to the beta that I use. If you want a different way of thinking about risk, I'm going to try to come up with a relative risk measure around it. So if it's volatility in earnings, I'll compute your company's volatility in earnings. Let's say it's 40%. I'll compute the average for the market. Let's say it's 30%. 40 divided by 30 is 1.33. That looks just like a beta built around something that you think is intrinsic. So if your problem is you don't like price-based measures, I can fix it. If your problem is I don't like the diversified investor argument, then that's even easier to fix, right? Instead of looking at beta, which measures how a stock moves with the market, I might look at standard deviation, the total standard deviation. I'm going to use that actually when I do private company betas, because there the owner is not diversified. The reason I make such a big deal about choices, you'll be surprised at how many people refuse to value companies because they don't like betas. A couple of years ago, I was in Omaha for that investor Woodstock. I didn't go to the actual meeting, but I actually was asked to come and talk to a group of portfolio managers. I don't know where they keep inviting me back because I keep insulting them. So I walked in, there were 200 portfolio managers, all true believers in value investing. So I asked them a very simple question. How many of you have actually valued a company? Two people in that room had actually valued a company. Saying, but they're value investors. They pick cheap stocks based on PE ratio. Low PE ratio is cheap, low price to book. They didn't actually. So I said, you call yourselves value investors. How come you don't value stocks? You know what the most common reason was? We don't like betas. What? Betas are a way of getting discount rates. You don't like betas. Tell me what you want to use instead. I'll come up with the discount rate. We can keep moving. This shouldn't be the fight that leads you to say, I can't do intrinsic valuation. So there are these alternatives, and I'm willing to put them on the table. If you don't like the CAPM, you don't like betas, you can go with relative volatility measures that's standard deviation based, that's total risk. You can look at what I call proxy models, right? You can look at the size of the companies. The big companies are safe, small companies are risky. I mean, you're making leaps of faith, but every alternative comes with its own consequences. Or you can take the CAPM and you can start adding other things to your number, saying, I'm going to add a premium for small cap stocks, a premium for illiquid stocks, trying to come up with a discount rate. My basic point is you need a discount rate. You need a risk adjusted discount rate. I'm going to get there by hook or by crook. You don't like the way I estimate betas, tell me what you don't like. I'll replace it with something that's closer to what you think of as risk in an investment. Okay. So accounting risk models out there, you can do accounting betas, you can look at earnings, you can look at qualitative risk models. Have you ever seen a value line page for a company? Value line is one of the oldest investment, I don't even know what to call it anymore. It's like a publication. You used to come up with one page for a company in the old days before you could access Yahoo Finance. You put up a value line page. And basically in every page, for every company, they had this ranking from 1 to 5. 1 being safest, 5 being riskiest, so they'd classify companies. God only knows what went into that classification, but you could, whatever you choose as your way of thinking about risk, stay with it and convert into a discount rate. That's all I need. Okay? What I'm preparing you for is when you go to work, there will be this grizzled managing director. Those beta stuff you learned in class, that's all nonsense. Say, okay, don't contest it. It is nonsense. So what would you use instead? And what would you like me to use as a risk measure? Because you need a risk measure to do intrinsic valuation. So I'm going to step back from this regression beta hole that we've dug for all of you in a finance class. Because you ask people, where do betas come from? If it's right after finance class, you say it's a regression. If you've been working for 10 years at Goldman Sachs and ask you where a beta comes from, you know what the answer is? Bloomberg. Betas don't come from Bloomberg. They don't come from regressions. They come from choices you make as a company. What are the choices? First choice, what do you do? What kind of product or service do you provide as a company? Think about it. Betas measure how you move with the market, right? The more discretionary your product or service is, the higher your beta will be as a company. Claire, what does discretionary mean here? When I say your product or service is more discretionary, what do your customers do? For the customer, right? You can delay buying it. You can defer buying it if you're not feeling it. You can push it off, right? The more discretionary, the higher beta. Why in good times, people buy your stuff. In bad times, they hold back. Let me try a little experiment on you. Let's take retail. It's a huge space with very different players. So I'm going to classify them into 4 groups. You got luxury retail. Gucci, Tiffany, Ferragamo. You got department stores. I haven't been in one in 12 years, but I think they still exist out there. Then you got discount retailers. You could go dollar store, but you don't have to go that low. It could be Walmart, it could be whatever. And then you have grocery retailers. So here's what I want you to think about. Talked about discretionary, non-discretionary. Based on what I said, can you start ranking these? Which of these 4 groups should have the lowest beta? Why? Because it's tough to defer buying food for months, right? We'll come back to groceries. So grocery store, which should have the highest? Yeah, you can live without your Gucci. You say, no, no, I can't make it. Trust me, you will be okay. Okay. So you should expect to see the highest betas for luxury retail and the lowest beta. But let's stay with grocery stores. You got Whole Foods. I live in a neighborhood where I have a Whole Foods and a Ralph's. Ralph's is an extension of Kroger's, which is one of the largest. What's the difference between the two stores? I go and buy groceries, but in Whole Foods, I can buy organic eggplant for 4 times the price of regular eggplant. And when I'm feeling good with and I'm making a lot of money, I'm going to go for the organic eggplant. But if I've lost my job, guess what? I'm going to die anyway. I'll buy the Kroger's eggplant. Who cares? Organic, inorganic. Within the grocery store space, you'd expect Whole Foods to have a higher beta than Kroger's. I wanted to start thinking about products and services. If you picked a company, and again, I'm going with this trust, you told me you picked a company, I want to think about what it produces, who it sells to, and is it the kind of item that people have to buy every month, every week, in which case your beta should be low, or it's something that can be deferred or delayed. So that's my first stop. What do you do? How discretionary is it? In economics, there's actually a term we use for this: discretionary, non-discretionary, right? What is it? Elasticity of demand. Every class you've ever taken in this school is in service of my class. You didn't know this until here. Elasticity of demand. If you have a product with elastic demand, it should have a higher beta. Sophia?
What do we do with companies that seemingly should have higher beta, but then there is, I don't know, in bad times, for example, in Soviet times, a lot of people would buy, like expensive house decor, expensive glassware because it was a better place for them to store money than a bank.
Oh, it's like a collectible then, right?
Some say, buy MS
Yeah.
specs hold their value very well.
I think it's a very small niche of companies you're talking about, where that's true, where you buy these because they might hold their value as collectibles, and in crisis periods, we know collectibles do well. So if you are Christie's, you know what Christie's does, right? It sells amazing fine art. You might actually find that your revenues go up in bad times because people, instead of putting their money into stocks, might come and buy Picassos. So let's set that aside, because we're going to come back and talk about those niche businesses. But for the most part, when you talk about discretionary, we're talking about the kinds of stuff that we can delay or defer. That's my first stop. So ask it about your company. What do they do? Is it discretionary? Second stop. Tell me something about your cost structure. What am I talking about? When you look at a company, some of its costs are fixed costs and some are variable costs that relate to the product. The greater the proportion of your costs that are fixed costs, the higher your beta will be as a company. You want to explain to me why that is? Why would having a lot of fixed costs make you more risky as a company?
Because you can scale them down in bad times, you will still have to pay them.
Think of COVID, right? Think of Marriott and Airbnb. Both hospitality companies, COVID hits. You know what Airbnb did? It laid off 80% of its employees, sent them home, and it brought its cost structure down. Its cost structure is flexible. What did Marriott do? It shut its hotels down, but it actually had to keep maintenance and security staff to make sure people didn't move into the rooms and decide to make it their own. They had the fixed costs, which means Marriott is going to have a higher beta than Airbnb. Businesses with a lot of fixed costs will have higher betas. I'll give you my favorite target for that. It's the airline business. Think about the cost structure for an airline. What's the biggest single cost? Now, first you got the aircraft. That's a huge lease cost. So the fixed cost or variable cost. You can't go to, let's say you leased it from G Leasing. You can't go back to them and say, look, our planes are only half full. Can I pay you half the lease, right? It doesn't work that way. It's a fixed cost. Next is, let's say, fuel cost. Fixed cost or variable cost? Variable if you can alter your schedule, right? But if you already set a schedule, you imagine the pilot coming out and starting to count the number of people on the plane. 1, 2, 3, 4, 5. And then yelling out of the window, only 6 people on the plane, fill it up halfway, let's see how far we get. Doesn't work that way. There won't be 6 people left on the plane. Most of the fuel cost is fixed. I know the weight can add to that. You go down item by item. Unionized airline, employee cost, fixed, 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 fixed. So what does that mean? 95% of your costs are fixed. Have you ever noticed that the airlines never have a normal year? They're making billions or they're going bankrupt. It's like watching a manic depressive in action, right? Everything gets magnified in both directions, and that's exactly what fixed costs do. So what do you do? What is it discretionary? What kind of cost structure? And there's a third stop I'm going to make, and I'm going to ask you whether you borrowed money. You think, why do you care? When you borrow money, you create a fixed cost you did not have until you borrowed the money, which is interest expenses. In good times, you have no problem. Bad times, you still have to make those interest expenses. It make your ultimately betas come from those three things. They don't come from a regression. They don't come from a service. So with that in place, let me talk about how best to estimate betas. I'm going to argue that the better way to think about betas is rather than run a regression, is to start with the business you're in and try to estimate a beta for the business. So if you're luxury retail, you should have a higher beta. Second stop, bring in the cost structure. It's called operating leverage. And if your company has higher or lower operating leverage than the typical company, you want to adjust for that. And the third stop is you bring in how much you have as debt into the process. So I'm building up to a beta, starting with the businesses, your operating leverage, and your financial leverage. You think that's not practical. How the heck are we going to do that? Let me take you through the process. Let's start with that second step, the operating leverage step. To get my operating leverage, what do I need to know? I need to know how much of your costs are fixed and how much are variable, right? I challenge you to pick up an income statement and start classifying expenses. Accountants don't do it. You can make guesses. You can say cost of goods sold, probably variable, SG&A probably fixed. The biggest problem with adjusting for operating leverage is not that we don't know how to do it. It's actually easy to do. It's the fact that you can't get the information in fixed and variable. So we're going to cheat. If you're a steel company, I'm going to give you the average beta for steel companies. If you're a chemical company, because I know that if you're a steel company, the very different leverage, I should be. So it is a problem because we don't have the information. It's not a mechanical, we know how to fix it, but we don't have the information to do it. So adjusting for operating leverage, we know what to do, but getting the information on fixed and variable costs is tough to do. Adjusting for financial leverage, much easier. Why? Because it's information, debt and equity. It's right there. It's on. So here I'm going to break betas down into two subgroups because we often talk about betas if it's one number. You might have heard this in the context of another finance class, maybe with a different term. But I'm going to introduce two different versions of betas. The first version I'm going to call an unlevered beta. What's the unlevered beta? It's a beta you would have had as a company if you'd chosen to fund your company entirely with equity. People often call this an asset beta, but basically you're saying, if I were looking at my businesses, what beta should I have? An unlevered beta. Then I'm going to introduce a second version of beta called a levered beta. In a levered beta, I take the unlevered beta and I adjust for the fact that you've chosen to use a lot of debt. And as an equity investor, it's a levered beta that you care about because I can take a safe business and make it incredibly risky by borrowing enough money. When you run a regression, you get a regression beta, right? Is a regression beta levered beta or an unlevered beta? Anybody want to try?
Levered.
It's levered, right? But here's my question. How did that even creep in there? I just ran a regression of stock returns against the market index. I didn't explicitly bring in leverage. So how did leverage enter the process? You're right, it's levered. But how did it sneak in there?
Plotting the returns, and the returns are already levered, unless the company.
So let's go through. So if you're a levered company, what happens to stock returns? They're going to be more volatile, right? Because everything's going to get magnified. It is a levered beta, but then think about what leverage is built into the beta. It's a debt to equity ratio you had as a company during the last 2 years, the last 5 years. It's not today's debt ratio. So regression beta is a levered. And if you want to unlever them, you have to do the work of unlevering. And we'll go through that process. But basically, you're taking out the debt effect. There's actually this equation that you see up there is called the Hamada equation for levering betas. It's been around since 1971. It's old-fashioned. A lot of finance academics don't like it. They tweak it. The biggest problem with it is it assumes that the beta of debt is zero, but that all of the market risk in a company is borne by equity investors. For the most part, that's not a bad assumption. It's not that debt is riskless. but there is no market risk in there. So if you look at a triple B, double A, triple A bond rate, what drives that rate has nothing to do with the company. It's mostly what's happening in the T-bond market. But if you go to double B, single B, triple C, and you take a look at those high yield bonds, guess what? They start to behave more like equity, right? Which effectively means that if you buy a junk bond, you're buying a bond with a big equity play in it because then the equation starts to fray. And people then, again, like betas, they try to throw the whole thing out. I'm not going to adjust for leverage because you assume the beta of debt is zero. There's a fix. If you have somebody who's adamant about the fact that the beta of debt is not zero, okay. Ask them for the beta of debt. Come up with. They'll give up right there. They'll say, use whatever you want. But let's say you can come up with the beta of debt, and there are ways you might be able to do it. There's an extended version of the formula where you can adjust the levered beta for the fact that lenders are going to take. I mean, intuitively, what you're doing is you're funneling off some of the risk to the lender, saying, my equity beta is not going to go up as much. So we have the mechanics in place for breaking up betas, deconstructing them. We're going to use that to come up with a beta for a company where you're not reliant on a regression. I call this a bottom-up beta, completely concocted. If you want to call it something else, go ahead and call it. Okay? So I'm going to make you my guinea pig. Okay? You're going to start a business. You're going to start a company, and you're going to be in two businesses. Pick the two businesses. You can pick any two you want. You want me to pick for you? How about cannabis and gambling? Sounds like so much fun, right? Let them smoke a lot of weed and then go into the casino. Who knows how much they'll risk. So you run a casino and you sell cannabis on the side, right? Two businesses, and you say, what's my beta? Here's what I'm going to do. I'm going to go back to my office and I'm going to collect as many publicly traded cannabis stocks as I can. Can I find some? Not if I stay in the US. Because the US, you actually have because cannabis has this patchwork of legality across the US, legal in some states. There are actually no US companies that I know of that are cannabis companies. But Canada has about 20 of them because it's legal all over Canada. So I find 20 Canadian stocks. I put up the betas for all 20. Hang in there. Can I find publicly traded casino stocks? There are lots of those. I pull up the betas for all of them. Let's say I find 100 of those. I average those out. Are those betas levered or unlevered? They were regression betas. They're levered. So I'm going to unlever the beta by taking out the debt to equity ratio of a typical cannabis company and the debt to equity ratio of a typical casino company. I'm going to end up with an unlevered beta of being in cannabis and casinos. And I come back to you and say, look, you told me you were in two businesses. Could you tell me how much value you get from each business? And your reaction might be, I don't know how much value I get, but I get 80% of my revenues from casinos, 20% from cannabis. You know what my next step is going to be? I'm going to take a weighted average of my two unlevered betas. I'm now going to have an unlevered beta for your company, and then I'm going to ask you a final question, which is, do you have any debt? If you say no, I'm done, because my unlevered. But if you do have debt, I'm going to convert it to a debt to equity ratio, and I'm going to come up with a levered beta for your company. So the mechanics are start with the business breakdown, come up with a beta for each business, take a weighted average, and then bring in the debt into the process. Akash?
Would the beta be affected by the fact that we're looking at Canadian companies?
What's the average beta across all Canadian companies? What's the average beta across all African companies? This is the nice thing about betas. It's scaled, right? Because it's scaled, I can go global. It actually gives me this advantage and it's an immense advantage. End of this month, 2 weeks from now, I'm supposed to be in Portugal, and I'm valuing a Portuguese company. If I said I'm going to use only Portuguese companies, I'm going to be in deep trouble because there are only 100 publicly traded stocks in the entire market. It's a tiny market. I've got to go across Europe, maybe even global, to get my betas. And the nice thing is, betas travel. Yeah. We'll talk about some of the questions you might have to ask, but I'm going to go with those Canadian. So when I'm done, have a beta for your company. And why am I doing all of this? Because I don't like regression betas, right? But where do I get the 20 cannabis stock betas and the 100 casino stock betas? From the same regressions. All I'm doing is replacing one regression beta with an average of 100. Hang in there with me. What is the benefit of replacing one regression beta with an average of 100 regression betas? It might not disappear, but it decreases. The law of large numbers, right? This isn't magic. And here's what happens. You have 100 regression betas. The standard error in each of them is high. What does it mean? Some of your betas will be overestimated. Some will be underestimated. You're just averaging out your mistakes. It's magic. But it's magic that comes from the fact that you have a lot of data. A bottom-up beta will be more precise than any individual regression beta. You're saying, what if I have only 9 companies in my peer group? It's still 3 times more precise. You're saying you're making up stuff. I do make up stuff. But how do I go from 9 companies to 3 times more precise? How does sample size tell you something about the precision of your estimate? You take the square root of the number of companies in your sample. You have 100 companies, it's 10 times more precise. Yeah. If you have 49 companies, 7 times more precise. 25 companies, 5 times. Anything beats a sample size of 1, which is what you had before I came along and gave you this average beta. A bottom-up beta is more precise. Second, he was only in casinos till last month, and then he entered the cannabis business. Why? It looked very attractive. There's no way a regression beta for his company would have captured that, right? Because I'm looking at 5 years of returns. But because I picked the weights, I can bring in the cannabis. In fact, I can be proactive. I can ask him, what other sin businesses do you want to be in? Obviously, you picked a theme, cannabis, casinos. Who knows what the other business might be? Alcohol. And I can bring that into the beta as well. I control the process. I'm no longer at the mercy of opening up Bloomberg, seeing a number there saying, I have to use it. I'm building up to a beta. It's more precise. It's forward-looking because you can bring in business mixers. And I now have a mechanism for estimating a beta for a company that has never been traded before. Okay. 2021 and 2022, I valued Zomato and Paytm in the Indian market. I've got more heat for doing that than anything else I've done in my lifetime, but that's a different story. They were IPOs. And I valued IPOs. I valued Facebook at the time of its IPO and Twitter at the time of its IPO. They're all on my blog. Every one of these companies valuing an IPO, what do you have? You have the financials like every other company. But if I went to Bloomberg and tried to look up the beta for a company that is going public, there will be no data there because there's no past prices, no past returns. But if I know what business Twitter is in, I'm going to ask you in a second what business Twitter is in because I want to kind of cut through the haze of how you get a beta for a social media company. Then I should be able to get a beta for Twitter by looking at publicly traded companies in that space. Which brings me a good question. What business is Twitter in? Don't tell me it's social media. It's not a business. Just like the internet is not a business. Yeah. It's advertising. It gets all its revenue. You think this is why when people say, I've invented a business, my point is, no, nobody invents business. You find new ways of delivering all businesses. Uber did not invent car service. Guess what? We used to take cars from point A to point B before Uber came along. We might have called them limo services or taxi cabs. Uber just invented a new way of delivering something that's always been around. So when you look at businesses, you might want to look, because one of the pushbacks you often get is, what if my company is inventing a business? AI, I hear that a lot. AI is not a business. You might use AI to be a better consulting firm, in which case you're a consulting business. You might use AI to manage inventory, in which case you're a business. So tell me what your product is, and I'll start building up to a beta for your company. Is everybody clear on the mechanics here, though? You start with the businesses. Yeah.
You said betas travel, right?
Yeah.
If there are 10 companies from 10 different countries, what do I regress the beta?
Good question. If you have only 10 companies, I would suggest you regress them against a common index, which would be a global index, the MSCI. If you have access to a Bloomberg, you can replace the index with what's called, I'll give you the symbol for the MSCI Global. So it'll run the regression. If you're doing this for 100 companies, I would say just the law of large numbers work in your favor, because using the wrong index is going to give you the wrong beta, but in both directions. That's the great thing about having a large sample size. You can get sloppy. You can say, I'm going to use weekly or monthly. It's not going to matter. I'm going to try different indices. It's not going to matter. The bigger your sample size gets, the sloppier you can become in how you estimate betas.
You would still use MSCI World or?
MSCI World would be what I use, yeah. So let me make my case, and I'll make this very, very real. The last 30 years, I haven't valued a single company with a regression beta as my beta. Every time I get to this choice, regression beta or bottom-up beta, I go the bottom-up beta route. So I find it very difficult to think of a scenario where you say, I want to use a regression beta because it's not working. I can't find a bottom-up beta. So it's less noisy, it's always updated, and you don't need prices. It gives me tools to estimate betas for companies, divisions of companies, private businesses that I otherwise could not use. So if you go to my webpage, I actually have betas by industry broken down to 93 different industries. I have global averages, US averages, emerging market averages. People think I do it for others. I do it for myself. Those are the beta pages I draw on through the course of the year to value companies. So I have to value a steel company this year. I just go look up the beta for steel companies at the start of the year. They don't change that much on a week-to-week basis. You're welcome to use them. I would suggest you do this at least on a small group so you can see the mechanics of doing it, because it'll make you comfortable with what you have to do, what choices you have to make, averages versus medians, for instance, a lot of statistical choices. But I think the end game is actually a very simple one, to come up with a beta for individuals. It's called a pure play beta for being in a business. So I'll tell you how, give you an example of how this will play out in real life. Take a company like Vale. Vale is a Brazilian company, but it's really a global iron ore mining company that happens to be in Brazil. So these are the businesses that Vale was in. Where would you get the business mix for a company? You just are dependent completely on them. Because accounting requires that if you get more than 10% of your revenues from a segment, you have to break it out. Okay? So if you go and look at the Disney business, they have theme parks, they have movies, now they have Disney Plus as a separate business, a streaming business. So you're dependent on that starting data. So the first column came from looking at Vale. Vale broke themselves down into a metals and mining business, an iron ore business, a fertilizer business, and a logistics business. Vale also told me how much revenue they got from each of these businesses. My job is to take those two pieces of data, business and revenues, and convert into a bottom-up beta. So here's the first step. Once I knew the businesses, I went looking for companies that I would use to get the unlevered beta. So for metals and mining and iron ore, I looked at global averages. Why with metals and mining is global average going to be a good choice?
These are commoditized.
It's a commoditized. They sell into a global market. You're an oil company. It doesn't really matter whether you're in Brazil or you're selling into a global oil market. So there is a slam dunk. I use the global average. Look at my sample sizes, 48 and 78. For chemical companies, because the kind of the fertilizer companies, I used specialized chemical, because fertilizer is just specialized chemicals. 693. This is the great thing about having a global sample of 48,000 companies, is you should never run into a scenario of, I can't find enough companies. 693 companies, the standard error saving is going to be huge. I can afford to be really sloppy. But with each of these, I've got an unlevered beta for the businesses. So what's the last step? I need to take a weighted average, right? I have revenues. I can just use revenue weights. But what's the problem with using revenue weights? Disney makes revenues in theme parks. It makes revenues in movies. It makes revenues from streaming. No income, but revenues from... Are all the revenues roughly the same to Disney, or are some revenues more valuable than others? Yes. Margins, right? You're in a high margin business. Revenues from a high margin business should be worth more than revenues from a low margin business, right? Costco. Their retail business is a low margin business. But Costco also provides a service business. You can get your roof, your air conditioner. That's a high margin business. If they gave me the revenue breakdown, I want to attach a higher value to their services business than to the retail business. And I'll give you a way we can do that. From that same sample from which I got the betas, I got the multiple of revenues that companies in that business traded at. So the way to read this is a typical metals and mining company trades at about 1.97 times revenues. A typical logistics company trades at 1.14 times revenues. You think why? The logistics business has much lower margins than the metals and mining, and it's showing up in the multiple. So if I take the revenues that Vale gets from each business, multiply by that, I have an estimated value for each of the four businesses, right? Those become the basis. What the heck is happening here? Those become the basis for my weights. Vale is about 76% iron ore, about 17% metals and mining, about 5% fertilizers, and about 2% logistics. The only rule is make sure the weights add up to 100%. Everything else you can be sloppy about, but the weighted average. Now, I would suggest picking a company, a multi-business company you're interested in, and breaking it out, right? Apple. What are the businesses you're going to find Apple in?
It sells you phones, it sells.
Smartphones. You got computers. There's
Other accessories.
accessories, which we can bundle in with one of the others, but they also have a services business, right? Everything that goes through the App Store. They have at least 3 businesses, and maybe 4, and each has a very different risk profile. Take a weighted average. You want a real challenge? Try Amazon, right? What is it in? What is it not in? Yeah. Yep.
Do we need to account for cases when one of revenue streams kind of enables all the others? For example, Apple would not be able to sell
That's a-
Apple Care if
yeah.
it didn't sell you the iPhone.
In some cases, drawing those lines, does everybody get Sophia's question? You've been in a Disney theme park, right? You've been the Avengers section of the Disney theme in Disneyland. It rides on how well the Avengers movie does. So, in a sense, when one business does well, so when you draw lines and this is the value of the theme park business, you might be overestimating the value of the theme park business because it lives off the success of the movie business. Now, if you want, and you don't want to finesse this too much because this is not the place. If you were doing a sum of the parts valuation, these numbers actually are going to, I would pay more attention to those things. But for the beta, I would just say make it a rough estimate and move on because you can always come back and revisit that. Okay. So those are the betas. I feed those betas into a levered beta equation. And here I ran into a bit of a problem. What do I need to lever the beta? I need a debt to equity ratio, right? By business. You open up a balance sheet for Vale. They don't break the debt down into each business. They just give me a total debt. I need market value of equity, but there's only one market value of equity. So I took the lazy route. I said, I can't estimate debt to equity. I'm going to give them all the same debt to equity, but I'll add a caveat. If one of these businesses was incapable of carrying debt, I might then make some judgments based on industry averages of saying this is the business that carries more debt. But you need that debt to equity ratio to come up with the levered beta. The levered beta gives me a cost of equity. The equity risk premiums, of course, reflect the geographies you're in. And I have a cost of equity for each division. I don't teach the corporate finance class. I haven't done it in 10 years. But in my corporate finance class, we spend a lot of time about coming up with costs of equity and capital for divisions of companies. Because to me, one of the biggest sins in investing in companies is using what's called a corporate hurdle rate. You know what a corporate hurdle rate is? You come up with a cost of capital for the company, use it for every project. It is disaster waiting to happen because you don't have to think through. You're going to create subsidization. Yeah, safe businesses are going to be subsidizing your risky businesses. This is a way of avoiding that. And the only way to do this is to build up to a bottom-up beta. So any questions on the process of building up bottom-up betas? Yes. No, risk-free rate is a currency choice. You could, that was all in dollars. You could do it all in Canadian dollars. You could do it in reals. So you want to be careful if you're bringing them all into a weighted average that you don't have different currencies for different businesses. So when you take a project, you can do whatever you want. But when you're computing a cost of capital for a company, you can have only one currency in that calculation, right? The Canada part will show up in your equity risk premium. So when you do the equity risk premium for that business, you might say this business is predominantly in Canada. I'm going to use the Canadian risk premium, which is same as the US premium, because it is in fact a safe part of Vale's businesses. Now, let me take a second example. And this one I struggled with a little bit. I was trying to value Embraer in 2004, Brazilian aerospace company. So I went looking for publicly traded aerospace companies in Brazil. Know how big my sample size was? One was called Embraer. I said, that's not working for me. I said, let me expand to Latin America. I ended up sample size of one, still Embraer. And then I said, why am I staying Latin America, folks? And that's when I asked the question, betas are basically betas. It doesn't matter where they are. So the beta that I'm using for Embraer is the beta coming from global aerospace companies, which are, at that time are primarily US and Europe based. And that unlevered beta is basically what I ended up using to get my levered beta. I remember presenting it in Brazil, and people saying, but you're using European company betas in US. You know the implied message there was, those are safer markets. Shouldn't the beta for Embraer be higher because it's a Brazilian company? Why not?
It's already included, right?
Exactly. And I want you to remember the answer that was given. When you're in a risky country, the number that captures your risk is your equity risk premium. Don't make your beta carry that weight because that'll be double counting risk. You can be the riskiest country in the world and I'll give you a beta 1. That doesn't mean I'm giving you a low cost of equity, because if I multiply that in Turkey by a 20% equity risk premium, your cost of equity is going to reflect the country risk. Each of the numbers in your calculation carries a different weight, right? Your risk-free rate reflects currency choice. I'm not going to punish a Russian company by giving it a higher euro risk-free rate. The euro risk-free rate is the German euro bond rate. The beta for a company reflects the business choices it made, and the equity risk premium reflects where in the world it operates. There's one exception to this global rule that you want to think about. Remember the discretionary, non-discretionary differentiation that I drew? There are some businesses, you could argue, that are discretionary in some parts of the world still, but non-discretionary in other parts of the world. I'll give you my favorite example, and this might not even be true anymore. Telecom companies. Now, I was always wary about using, because for a long time, if you're looking at an emerging market telecom company and use developed market telecom companies, you're effectively assuming that phone service is non-discretionary, because in much of the West, phone service is non-discretionary. This is before the days of smartphones. But you took parts of the world, there were big segments of the population with no phones, and whether they would get phones depended on how well that country was doing. So what you had was phone service being non-discretionary in the West and discretionary in emerging markets. You see where this leads, right? When I compute a beta for an emerging market telecom company, it should be higher than the beta for developed market telecom companies. And that's why I have that emerging market average. If you're in a business where you feel that emerging market companies, this is a much riskier business because it's discretionary, then use the emerging market average. One final mechanical detail. For those of you who will end up working outside the US, when people talk about debt in Europe and Latin America and much of the rest of the world, they're talking about net debt, not gross. You say, what gross and net? What are we talking about? When I ask you how much debt a company has, and you go to the balance sheet and you look up the debt on the liability side of the balance sheet, that's gross debt. That's how much the company owns. What's net debt? What are we netting it out against?
Okay, short-term investments.
If you take cash on the other side, so let's say you have 500 million in debt and 200 million in cash, net debt, you take the 200, and you can see the logic here, right? If I have cash, if I chose to, I could pay off the debt. So a lot of debt ratios outside the US are net debt ratios. So one of the big challenges or questions I get is, should I use a gross debt ratio or is it okay to use a net debt ratio? My answer is, if you stay consistent, it doesn't matter. Let me explain. When I did Embraer, I used the gross debt to equity ratio to get the 1.07, and my levered beta was higher because my gross debt ratio was 19%. If I chosen to use a net debt ratio, my net debt ratio would have been minus 3.32%. You say, how is that possible? The cash balance exceeds your debt. Your net debt ratio can be negative. If I use the net debt ratio, my levered beta is actually lower than my unlevered beta because I'm going the other direction. If I just stop there, you're saying, I'm going to get a lower beta and a lower cost of equity. Shouldn't my value be different? Not so fast. Where does the cost of equity go? Into a cost of capital calculation, right? What do I need to get to from cost of equity to cost of capital? I need a cost of debt and I need weights for debt and equity. When I do the gross debt ratio, my cost of equity is going to go into that equation. My debt ratio is going to be maybe 15% based on the 18.95% debt to equity, maybe a 15% debt, 85% equity, and I'm going to come up with the cost of capital based on that mix. But if I use a net debt ratio and I get to the cost of capital calculation, help me out. What's my equity weight going to be? If I have a negative net debt ratio, it's going to be greater than 100%. Hang in there. You got to work. If you chose the net debt ratio route, you got to be willing to live with this. Your equity ratio might be 102%. Your debt will be minus 2%. You will get none of the benefits of a lower cost of debt. Your cost of capital, you can test it out if you want, will be roughly the same in both approaches because you stayed with net debt ratio all the way through. So I don't have a problem with you doing net debt ratios as long as you stay consistent with that all the way through. So we have all the numbers we need for cost of equity. Let's summarize. Risk-free rate based entirely on currency choice. Make sure it's default-free. Sophia?
If net versus gross debt doesn't matter as much as long as we're consistent because of fixed nature, should we then prefer the gross debt because it allows us to account for the tax effects of that?
I prefer gross debt. There is a tax effect and also the fact that your net debt ratio can very quickly dissipate, right? Let's say you have $500 million in debt and $500 million in cash. With the net debt ratio, what's your net? It's going to be 0%. So the question I would have for you is, let's say you're one company with no debt and no cash, and another company with $500 million in debt and $500 million in cash. You're treating them as equivalent with the net debt ratio. In my world, they're not equivalent. The company with the $500 million debt and $500 million cash, I worry about more. Why? Because they could do a stock buyback tomorrow, and I'm going to face a problem. So I prefer gross debt, but again, there are fights you choose to fight and fights you choose to pass on. This is one where if somebody says, I will use only net debt ratios, I'll say, okay, just stay consistent. The ultimate effect on, there might be a small effect on the cost of capital, but it's small enough that I'm willing to let it go. But be willing, I mean, I think you make a good point. When you want to make the case of, I want to use gross debt ratios, explain why you think gross debt ratios give you a better sense of risk and value than using net debt ratios. It's a fact that cash can go up and down and you're treating firms as equivalent when the net debt ratio is the same. And that's not always the case. Right? So your risk-free rate comes from your currency choice. Your beta comes from the business mix you have as a company. Your equity risk premium comes from the countries you operate. Everything has its place. I think the problem is when people try to do too much, they end up double counting and triple counting risk. By too much, I mean increasing the beta because you're in a risky market, using a higher equity risk premium, using a government bond rate. I don't even know how companies end up being undervalued if you punish them 3 times for the same crime, right? And that's exactly what you're doing when you're counting in multiple places. Let's talk about the cost of debt. I'm going to give you what I'm looking for, and then we'll talk about how best to get there. When I'm looking for the cost of debt for a company, I'm looking at the rate at which this company can borrow money long term today. 2 keywords there, long term and today. First, let's take the long term. When you look at the actual debt in a company's balance sheet, is it all long term debt? No, there'll be 1-year debt, 6-month debt, commercial. I'm going to take all the debt and act as if it's long term debt. And you know what? CFOs push back. Why? Because usually short-term debt with the term structure has a lower rate than long-term debt, and they want a low cost of debt. They say, I have a lot of 1-year debt. Why aren't you giving me credit for the fact that my rate is lower? What do you think the answer to that is? No, if I let them get away with it, you know exactly how they're going to lower their cost of capital, right? They're going to take all their debt, make it 6-month debt, and say, look, my cost of capital went down. I can't give them that escape hatch. You take 1 year debt. What do you have to do at the end of 1 year? You have to take in, no. You know what the rolled over cost of 1 year debt over the next 10 years is? It's going to be roughly equal to the 10-year cost of debt. So this is not a fight about you should take long-term debt. I'm saying whatever debt you take, I'm going to treat it like long-term debt. It makes your life so much simpler and it gives you a much more effective number. What's the today part doing in here?
Yield to maturity is not always interest rate of existing debt. So if you-
Exactly. I don't want you to tell me what rate you paid on your bank loan 2 years ago. Don't give me what's called a book interest rate, interest expense divided by book debt. I want to know what rate you can. And again, this actually makes my life easier because the minute I say that it's going to be the rate at which you can borrow, then I know how to get there, right? I start with the risk-free rate and I have to add a default spread that I see in your company today. So let's talk about easy ways and more complicated ways to get this cost of debt, depending on the company you're looking at. If your company has a long-term bond trading out there, there's a price in the bond and there's a yield to maturity, right? If you truly think that this bond is a clean measure of risk, you can actually take that yield to maturity and use it. I almost never take this route, and I'll explain why. One is, can a risky company issue a safe bond? How would I do that?
It's very high up in the capital.
In other words, if I secure my safest assets and I borrow against it, I can issue a bond that the rates look low, but I can't attach that to the rest of the company because it's based on a very small segment. So my problem with using the yield to maturity in a bond is who knows what backs up that bond and what rate I'm at. But if you have bonds outstanding, there's something else I also will generally know about you that I can use to get your default spread, which is there's a bond rating. But is that to issue bonds, do companies have to have a rating? You don't, but they almost always will, because if you decide to go to the bond market and say we've refused to be rated, what does the bond market read into that message? You must have something to hide. So almost always, if you see bonds outstanding, you'll see a rating. In fact, there are many companies which have no bonds, which will have a rating just in case they have to issue bonds. And that's a godsend if you're doing valuation. Why? Because you've outsourced default risk. You use Moody's or S&P's. You say they could be wrong, but think how much time you save not having to do it yourself. So if you have a bond outstanding or a rating, I can get you default spread. But the question is, what do we do when we don't have either? What percentage of companies around the world do you think issue bonds? Let's see if we can get that, just throw a number out because it's almost a random. Do you think it's a high percent or a low percent? It's a low percent if it's global. It's a high percent in the US. The US has the most established corporate bond market any part of the world. It used to be 0% outside the US until about 30 years ago. Now Europe, it's about 30%. Asia, it's starting to get 20. India is a very active corporate bond market. Didn't exist 25 years ago. So for about 25% of companies around the world, I can find a bond rating. Out of my 48,000 companies, about 12,000 are bond ratings. I can use that. The other 36,000, I'm saying, what do I do now? So for a brief moment, I have to act like a ratings agency, and thank God they're the most transparent institution in the world, not because they want to be, but because of what they make public. So what do you learn from a ratings agency? They give you the rating for every company they've rated, right? If you go to the S&P website, they used to have the 8 ratios they used to use. They actually said, these are the 8 ratios we use. There's very little private information in this process. It's almost all based on financial ratios. So 30 years ago, when I said I want to be like a ratings agency, here's what I did. I downloaded the rating for every rated company, downloaded the 8 ratios, and then I did some reverse engineering. What do you think I did? What's the reverse engineering? I basically did a sort. So think in Excel, I sorted the companies based on ratings from AAA down to C, and then I looked at the ratios and said, can I use the ratios to see what's happening? You don't need AI to do this, right? This has been around for 30 years. You can reverse engineer. And I discovered 2 things. One is 7 of the 8 ratios seem to be along for just the ride. 1 ratio seemed to be carrying the bulk of the weight, if you looked at the R squared. It was the interest coverage ratio. You know what the interest coverage ratio is? Do you remember from accounting?
Like EBIT over interest.
It's EBIT over interest expense or operating income over interest. You're saying, what does it measure? Think like a lender, right? You're lending to a company and its interest coverage ratio is 8. For every dollar in interest expense is $8 in operating income. You feel a lot more secure than if that company has an interest coverage ratio of 3. So I latched onto the interest coverage ratio and I said, I'm going to create a lookup table based on rated companies. But if you tell me what your interest coverage ratio is, I'm going to guess your rating. So let's take a company. 2002 and 3, Embraer had an interest coverage ratio of 3.56. I used an average income because remember, I have to think like a lender. I don't lend based on how much money you made last year. I look at what you made. You're saying, what do I do with the 3.56? How do I convert to rating? Here comes the interest coverage ratio table. The updated version of this is on my website. Okay. Again, it's not magic. I mean, it's not a black box. Basically, I'm taking rated companies. So with the 3.56 interest coverage ratio, if I, and you're saying, why are there 2 columns? Because the world is not fair. If you're a large company, I give you a higher rating for the same interest coverage ratio than if you're a small company. If you're an emerging market company, I give you a lower rating than a developed market company. So I take your interest coverage ratio, I go across and I look at the rating that goes with that interest coverage ratio. The rating goes with the default spread. That comes from the market. That you can update it every month. There's actually a great site where you can look up the updated corporate default spreads for companies. So for companies with ratings, don't mess with it. Just take the rating. Don't ask whether S&P is right or wrong. It's not worth the hassle. But companies without ratings, you take this extra step of interest coverage ratio to rating, rating to default spread. Is eventually that default spread has to feed into your calculation. So with my interest coverage ratio for Embraer, given that it got so much of its revenues from developed markets, I gave it I'm going to call it a synthetic rating. You know why I put the synthetic in there? It's not Moody's. I've made up a rating, and I want to be very clear that unless Moody's puts a little R next to it and sues me about this. Okay? And the default spread with it is 1%. So we have the mechanics to do this. I would like you to see, again, I'm assuming you are not lying to me when you said you picked a company. See if your company has a bond rating. If it does, you're home free for the cost of debt. At least start that process off. And I will see you next Tuesday. So reminder again, we have class on Tuesday and Wednesday of next week. This room, 3:30 to 4:45.
Are you at all concerned about like Moody's being wrong about their ratings? Like